Thank you for watching Edupedia World videos. In this session, we'll learn about accounting basics for sales and purchasing. We will cover some general accounting conventions and give examples of automatic journal entries that are created during the sales, purchasing, and inventory processes. We will also talk about some financial settings that affect these journal entries. Let us start with introduction to this session series. We will learn about general accounting concepts. We will understand automatic journal entries in sales and purchasing, and we will see about financial settings. To begin with, let us take the following business scenario. Let us imagine that you are implementing SAP Business One at a new customer. Your main contact is an accountant. The accountant is very interested in implementation and asks you about SAP Business One, how it handles the financial accounting process. Accountant wants to make sure that she understands the big picture so she can report business results to the company owners each period. So accountant is your point of contact in the company. Accountant wants to learn how SAP Business One handles finance. She is interested in learning about reportings too. Let us see some basics of finance business transactions. Finance basis: system configuration, master data, purchasing, inbound logistics, warehouse management, production, outbound logistics, sales and marketing and services, and financial accounting. Every business transaction is recorded in the company's book. This allows you to manage your company effectively with the options of producing financial reports. To report the business transaction to authorities, every business transaction results in a value exchange. That means a certain account increases value and another decreases value, resulting in the recording of balancing debit side and credit side postings. This is the basic system configuration where you have master data, purchasing, inbound logistics, warehouse management, and outbound logistics. And all these things form the basis of finance. Let us understand how automatic journal entry functions. There are documents in sales process that create automatic journal entries, therefore affect the accounting system. These documents are delivery, AR invoice, incoming payment, and deposit. You have to notice that delivery only creates an accounting posting if you are using a perpetual inventory. So starting with sales quotation, it is converted to sales order, then to delivery, then to AR invoice, then to incoming payment by payment means, and deposits. So these are the documents that are highlighted. They create automatic journal entry and affect the accountings. AR invoice journal entry. In SAP Business One, a journal entry is automatically posted for many documents during the sales process and inventory processes. Let us assume for a moment that we are in a non-perpetual inventory system in order to keep our example simple. In that case, in our sales process example, the AR invoice automatically creates the following journal entry. There is a debit to the customer account for total price of the sale. There is a credit to the tax account for sales tax and a credit to the revenue account for sales price excluding tax. Let us focus on debit side. Each transaction registered for customer affects the customer account balance. Now let us take a look over customer account in more detail. The account balance. This is an example of customer account. The account balance represents the difference between total debt transaction and total credit transaction recorded for that account. The transaction summary or balance of a certain GL account or business partner is initial information in the accounting system that can provide about the business. In the graphic we see total debits are greater than total credits, so the account has a debit balance. Previously we mentioned that in each journal entry a certain account increases value and another decreases value, resulting in recording of balance debit side and balancing credit side postings. The effect of account balance would be assets, expenses, and drawings account are generally in debt liability, revenue and capital, that is equity, accounts are generally in credit. Let us continue with account types. Here we see the typical account balance of different account types. For example, let us look at the value exchange for assets and liabilities. For assets, debit transaction always increases the asset value, credit transaction always decreases the asset value. For liabilities, credit transaction always increases the liability, debit transaction always decreases the liability. We will discuss the different account types in a later course. In a typical AR invoice, what is the effect of debit and credit amounts on the involved account balances? This is an important question that we can ask ourselves. Once again, if we make some assumptions to keep the example simple, let us assume that the customer is tax exempt and that this is a non-perpetual inventory system. The answer is that two accounts increase their value. The customer account is considered as an asset, so any debit to this account increases the account's value. A credit to revenue account, as we saw on the previous slide, increases the account's value. Note that you can preview the corresponding journal entry posting and involved accounts before you add a document that generates journal entry. You can do so by choosing the journal entry preview icon from the toolbar on right-click the document and choosing the journal entry preview options, which we will see later on when we jump to the application itself. We will see some financial settings in the next sessions. Thank you.